Sorry about that. Okay, thank you so much for joining us today. Again, my name is Soka Yus. I'm with Mayo Employees Federal Credit Union. I'm a financial wellness counselor here, so thank you so much for joining us today. Today we're going to talk about Student Loans 101. This is just the basics of student loans, just to cover, do an overhead overview, like a 30,000 feet overview of student loans. So if you have any personal questions on your student loans, what's going on with it right now, please reach out to me. I'll be more than happy to get back to you and set you up on a schedule so we can meet and talk about your student loans and anything else you may need. This is my contact information. So my phone number and email address is right here. If you can't write this down now, you can always look it up on mayocreditunion.org. My contact information should be on the financial education tab of it. And my contact information will be at the end of this presentation as well. So on today's agenda, so we're going to try to pack quite a bit into this hour presentation. We're going to talk about the free application for federal student aid. Moving forward, we'll just call it FAFSA. We're going to talk about budgeting for college expenses, identifying your loans, maintaining financial aid, student loan repayment options, student loan forgiveness, especially the public service loan forgiveness. That's, I meet with a lot of people when they talk about their student loan forgiveness. I usually meet with them about their public service loan forgiveness. And prepare for payments. And we'll also discuss, what if I can't pay my loans, what to do then? So we'll just get started here. So again, the free application for federal student aid, otherwise known as FAFSA, is an application that you fill out each year before college starts. So you'll go to studentaid.gov. You'll create a profile if you you don't have one already. You'll create a profile for the students. So if you're a parent watching this and you want to know, who should the profile be created for, it should be for the student, for your dependent, I should say. And then you create your profile, update that information. They'll ask you a whole bunch of information and then just go through it. But if you have a hard time, trying to figure that out, I'll be more than happy to meet with you and get that set up too. So it's your college uses your FAFSA data to determine your federal aid eligibility. So the application opens every year on October 1st, today. So today it opens up for the 2026 and 2027 academic school year, and you have to apply annually. Okay. So what happens if you, let's say for this year, you made more than last year, and you want to use, for last year you make quite a bit more on your taxes than you did this year, but they have to base off your FAFSA application based off of your tax, your tax information from last year, but you're not making as much this year. What should you do then? You should just reach out to your school, ask them to review for special circumstances. They'll be more than happy to discuss it with you and see if there's other special programs that you can be qualified for. So again, you have to apply annually, and it's based off of your last year's tax returns. When it comes to budgeting for college expenses, you want to complete your FAFSA application. So remember, FAFSA is a gateway to $150 billion in federal student aid, as well as certain state and school aid programs. Okay, so remember, this is just the application, and then it opens doors up for you for different federal, federal assistance and federal aids, and also for your specific school programs too. So remember to reach out to your representative of your school to see what other kind of scholarships, what other kind of aids that the school have available for you. You can apply for those directly as well. Next, you want to estimate your yearly total attendance. So according to educationdata.org, the average cost of college in the United States in 2025 is $38,270 per student, for a student per year. That includes your books, your supplies, and your daily expenses. So if you go to a four-year university, that's roughly $153,000 per year. So you don't want to put all of that on your student loans. So there's other, scholarships and aids and stuff that you want to look into to qualify for and to apply for and to use before you actually get student loans out. Just to give you a graph, just to give you an image of how expensive college has gotten. So this is by the annual cost of tuition and fees for a four-year institution in the thousands of dollars. So for example, in the 1970s or 1970, it's $1,700 to attend school per year for if you do, just a regular state college or state university. So now in 2023, the last data that we have here is $38,400 per year. So as you can see how much, things has blown up. So you can take a look at this graph. It's going to be available. You can find this graph in Education Data Initiative source as well. if you want to take a look at this a little bit longer. So consider your financial sources for paying for school. So once you fill out your FAFSA, you might be eligible for federal Pell Grants. So the minimum awarded each year is $7,395. In July 2026, they're going to roll out a new Pell Grant. It's another portion of Pell Grant, so it's called Workforce Pell Grant. So what that does, it's a new federal initiative that expands to the traditional Pell Grant to cover short-term, high-quality job training and credentialing programs. Some of the programs they'll cover are going to be stuff like EMTs in the medical field, or CNAs or medical billing coding specialists, or they might cover the programs for HVACs, plumbing, electrician and welders, or if you want to go into IT, they cover courses for cybersecurity. Some of the course length, it usually have to be between 8 to 15 weeks long, and in between 150 and 599 clock hours of instruction. So it's supposed to be for shorter programs that are supposed to give you and the programs has to be high-skilled, high-wage or in-demand industry, so they can't just be just any regular, industry out there or other jobs out there. So look into that. That's going to be available in July 2026, okay? So the lifetime limit for both traditional and workforce Pell Grants, there's a lifetime limit for that. And remember, grants does not have to be repaid at all. So grants can, you can find these Pell Grants available through your through your FAFSA application on student.gov. But you can find grants from other places too. You'll be able to find grants with this institution directly, or you can have state grants that are available to you. So it's a matter of you and your school representative. You can do some research and apply for more grants too outside of the Pell Grants. You can also qualify for scholarships. So we have scholarships here at Mayo Employees Federal Credit Union too. You can look into that on our website. I know Mayo have some scholarships as well, and other institutions have other scholarships. It may be directly with your school institutions that may have extra scholarships, maybe the states, what other scholarships you might qualify for. So it's a good idea to do some more research on that. You can find more scholarships on fastweb.com. And another thing you can qualify for once you apply for your FAFSA is federal work study. Things to consider, you have to submit it through your FAFSA form. It provides funds directly to the institution to administer campus-based work study. Jobs are limited, so you want to act quickly. So after you've exhausted all that, you can look into paying through your personal funds, right? So if you're parents, looking to pay for your kids' college, and you already set up a 529 plan, an education investment plan from when there were kids or teens, you can use that for college. So that's a route to go. If you're, if you just have a young child or a baby now, you can always start that. There's always employer tuition assistance. I know Mayo Employee Federal Credit Union has a program, and also Mayo has a program too, so look into that. You can use a portion of your Roth IRA to put towards education as well, or you can use your own personal savings, or of course family and friends if they're able to help you out too. Once you have exhausted all of that, the last thing you want to look into is federal student loans, right? Anything for loans. So federal loans are government issue. They generally have lower interest rates, and the government pays the interest when taking more than 6 credits out. So that's considered subsidized loans. Subsidized loans is when you're in school and you're like in school for half the time, or consider in school part-time, to full-time, the government pays for your interest, pays on the interest on your subsidized loans. Does not require a credit check. You're eligible for loan forgiveness and income-driven repayment plans when you take out federal loans. Parent Plus loans are eligible also. You have to take it out for your biological or adoptive child, and it has to be your dependent of an undergraduate student enrolled half-time or more at an eligible school based on your credit worthiness. So Parent Plus loan is based on the parent's credit. Graduate Plus loans ends in July 1st, 2026. So personal loans, if you got your federal student loans and it still wasn't enough to cover all your expenses, you can also look into personal loans too. They're issued by private lenders. We are one of them, Mayo Employee Federal Credit Union. We provide student loan lending as well. Generally higher interest rates based on whatever the market is doing right now. They're not subsidized, meaning that you have to pay for the interest. They require a credit check for yourself if you're applying for yourself, if you're applying, or if your parent is applying for you, or if you need a co-signer, it's based off of their credit. Doesn't typically offer forgiveness or income-driven repayment plans because it's just like your own regular loans out there with any institutions, doesn't usually get forgiveness on that. You can have it's usually fixed rate loans. It's better, but some loans are offered under variable interest as well. And as of July 1st, 2026, the Parent Plus loan options are reducing the amount that students can qualify for, can borrow for. So we'll see more of an increase on number of private student loans applications. Any questions online or anything? No? Okay, perfect. So after you received your loans, we want to identify your loans, right? We want to know what kind of loans do you have, or you want to understand your loans as well. So under federal loans or federal student aid, FSA, you can, again, you get these through, by applying your FAFSA. You can log on to studentaid.gov to take a look at your loans. This is the main website that you can go to take a look at your federal student loans, and they'll be able to tell you if it's subsidized or unsubsidized loans, or if you cannot have access to your studentaid.gov for whatever reason, you can always reset your password, create a profile to look it up. You can always go to your credit report. You can go to annualcreditreport.com. It's a free website. It's a trusted website. I use it here. I use it with a lot of the members that I chat with. But you will not get your credit score. You don't need to really care for that. You just kind of log on just to make sure, to look over your credit report, just to make sure everything on there is correct. And then you can take a look and see which student loans you owe, and they'll tell you on there as well. So identifying your loans, when we talk about direct subsidized loans, these are available to undergraduate students with financial needs. Now, the school determines how much you can borrow, and the amount can exceed your personal financial needs. You are responsible for the interest for the majority of the loan, but because it's subsidized, while you're in school for at least half time, the U.S. Department of Education pays for the interest on that. So for the first 6 months after you leave school, this is considered your grace period. The Department of Education pays for your interest rate, your interest fees on that too, and during a period of deferment. So what does this look like to you? So for example, in this situation with Alex, if he owes $27,000 in direct subsidized loans, and remember it's subsidized, so the government pays for his interest while he's in school and for the first 6 months while he's out of school. So repayment, when he gets out of school, he'll just pay the $27,000 back, no interest included on there. So after 10 years of consistent payments based off 6.59%, he'll pay a total of $36,664 towards that $27,000, based off of that $27,000, no added extra interest. Now, when we talk about direct unsubsidized loan, this is for undergraduate and graduate professionals or professional degrees. There's no requirement to demonstrate financial needs. The loan amounts are typically higher, and the school determines the amount based off cost of attendance and other financial aid received, and you are responsible for paying the interest from the moment it's dispersed to you, okay? So what does this look like for Alex, who owed $27,000? He's in school and the government does not pay for his interest. He's responsible for that. And if he chooses not to pay for any of the interest while he's in school, by the time he's out of school, he'll accrue $7,600 in interest. Now that's 4 years of school, plus the 6 months that he's not paying during his grace period. Based of 6.59% of interest rate, he's paying an additional $7,600. So when he does start making his payments again, it's based off of $34,600, and over a course of 10 years, he's going to pay a total of $46,800 based off of $34,600 versus the $27,000 before. Okay, so that's the difference there. So different types of federal student loans. Again, we have the direct subsidized loans, direct unsubsidized, the direct Parent Plus loans, and if you choose to do a direct consolidation loan where you consolidate all your subsidized loans together, and then you can consolidate all your unsubsidized loans together. So the annual award for direct loans, subsidized loans, usually about $5,500, depending on the grade level and dependency status. Direct unsubsidized, about $20,500. The maximum for direct plus loans, maximum amount is the cost of attendance determined by the school minus any other financial aid that a student receives. So maintaining financial aid. So once you receive your financial aid, you apply for your FAFSA, you received your financial aid, you've exhausted all your personal funds and stuff to pay for it, and you want to maintain your federal financial aid. What do you need to do? You still have to, there's still satisfactory academic progress. So you have to finish and pass at least 67% of your classes. You have to have at least 2.0 for undergraduate and 3.0 GPA for graduate degrees. And you have to finish your degree within the time allotted. For more on this, you can always go to studentaid.gov. If you're having a hard time, obviously, maintaining these grades, you can always talk to your academic advisor and see what else they can do to help you, okay? So now you've already finished school. Now we're going to talk about student loan repayment options. What options do you have? So student repayment, we have standard repayment for 10 years, graduated 10 years, extended repayment for 25 years. And there's different forgiveness programs, public service loan forgiveness, the teacher loan forgiveness, and the income-driven forgiveness. We'll go into details here in a little bit. And what kind of cancellations or discharge are there? The borrow defense to repayment, the legislative acts for forgiveness. So this is for the standard repayment, right? So if you choose to do a standard repayment, you finish school, you started paying after 6 months, you found the job that you want to do, and you decide to just pay it back. So that takes up 10 years. So payments are fixed amount to ensure the loans are paid within 10 years. The payments might be a little bit higher too, but at least you'll have all your loans paid back within 10 years. Or if you can't pay the standard, the request, you can apply for the graduated loan repayment type. So some of the loans that are eligible is listed there, but the payments are typically lower at first and then increase every 2 years after that, assuming that you get a raise, every year, every 2 years, that you'll get a little bit more money too. So the payments increase every 2 years. And payments are designed to ensure that the loans are paid off within 10 years. So it'll start out small and then it'll just, creep up to ensure that everything is paid off within 10 years. So it gradually goes up. The extended, to qualify for this plan, you must have more than $30,000 in outstanding direct loans, and payments can be fixed or graduated, and ensures that the loans are paid within 25 years, okay? So take 25 years to pay off your student loans if you want to do that, and then you might want to qualify for the extended repayment program. So this is what it might look like for a situation with Alex, right? So Alex owed $27,000 based on 2025, 2026 average rates of 6.39%. The type of loan that he has is an undergraduate. So for the standard repayment, when Alex repays back or repays his payment, the first payment is about $302 a month. Total interest paid for over 10 years is $9,235. The total repayment amount based off of the interest plus the base student loan balance, he's paying a total of $36,235. So the pros for this is repays the loan the fastest, resulting in the lowest overall cost, right? But the cons is the higher monthly payments. It's higher than other options. So if Alex can't pay the $302 each month, what he can do is he can choose the graduated repayment program. You can start with the lower standard payments. It increases every 2 years, as mentioned. The higher, it has a lower initial cost, but it's helpful to expect the income to increase over time. So the higher total interest cost over the lifetime of the loan is a little bit higher too. So up to 25 years for the extended repayments is a fixed or graduated payment. Provides the lowest possible monthly payment, offering flexibility during tight budgeting periods. And once you're set on these repayment programs, you can always, switch it up. If you find that the first 5 years, of your repayment relationship with Nelnet or your student loan servicer, you can comfortably do, $302 each month. But then you find, once you get married and you have a baby, you put your baby in daycare, the expense is really high, and you can no longer afford the $302 a month. You can always reach out to them and be asked to put on a different payment plan as well. And then we can talk about the federal student loan forgiveness. The income-driven loan forgiveness is a plan that offers forgiveness on federal student loans after a specified repayment period, which is typically 20 to 25 years of qualified payments. So the breakdown of it is, so it's based off your monthly payments on your income and your family size, and the end of the balance of your student loans after 20 or 25 years, whichever one you guys agree, to be set up on, will be forgiven. So anything after those couple of decades, the balance will be forgiven then. But you have to continue making those, qualifying payments. For example, if it's 20 years, you have to make 240 qualifying payments. So the forgiveness timeline, again, is anything after the 20 or 25 years. But there's different payment programs or plans that you have to be part of if you're under the income-driven repayment program. One of them is under the SAVE program, Saving on a Valuable Education. It's no longer available for you to apply for, but those of the people that were on it before are still considered under the SAVE program. This is from the last administration. So this is some of the breakdown that is, that you can take a look at this. Again, it's going to be available on studentaid.gov too. Another plan that you can apply for is Pay As You Earn program, income-based repayment program, or income contingent repayment program. So if you're having a hard time trying to figure out what is the best plan for you, by all means, meet with me. We can take a look at your budget together to see what you can afford, and that way we can call your student loan servicer together and say, you know what, this is what this person can afford. What is the best plan for this kind of forgiveness? So this is what it might look like for Alex, right? Oh, $27,000 with the interest rate in this scenario, 5.5%. They're going to take a look at your adjusted gross income. So in this situation, it's $40,000 for a household of one. In this county, the poverty guideline is $15,312. We're going to talk about discretionary income here too, so this may be considered DI here. But so the standard program, if he chooses to do the standard 10-year fixed program, it's going to be $293.02. But under the SAVE program, if he applies for the income-driven repayment program, it's based off of 5% of his discretionary income. So you'll see the calculations there, but the monthly income will be the lowest for the SAVE program is $23.12. Since you can no longer apply to be on the SAVE program, you can apply for the others. So Pay As You Earn program, the PAY program, will be based on 10% of your discretionary income. You see the result there. It's going to be $141.93. But it kind of just gives you a breakdown of how big of a difference each payment is, depending on what kind of payment program you're on, right? So a lot of these are going to be a bunch of numbers, a bunch of acronyms and stuff being thrown out. It gets really confusing. I completely get it. So again, if you have any personal questions about your own personal student loans or your dependent student loans, by all means, just reach out and I'll be more than happy to help you. So now we're going to talk about the Public Service Loan Forgiveness Program, which if you work at Mayo or any nonprofit, you'll qualify for that. So it has to be reapplied annually. The Public Service Loan Forgiveness Program is for direct loans. It's after meeting 3 core requirements of a 10-year period. So you have to pay, the qualifying employment will be Mayo's one of them. You have to work at least 30 hours per week to qualify for this program. And you have to pay it over a course of 10 years, so 120 qualifying payments, and you have to recertify every year. So you have to reapply annually. Qualifying loans must be federal direct loans. You can consolidate the federal family education loan into your direct loans as well. Qualifying payments, you have to pay 120 separate payments, separate monthly payments, and the payments must be made under the qualifying repayment plan, okay? So in this situation, let's take a look at Alex. So $27,000, same scenario, 5.5%. He's making $40,000 adjusted gross income. Poverty guideline for his county is $15,312. So if he chooses to do the payment calculation for the PSLF program, monthly payments. So his forgiveness after he make his payment, and if he's on the SAVE program and he's paying it for 120 payments for the next 10 years, he'll pay, his total forgiveness will be $24,225.60 because he will pay a total of $2,774. So that's why that forgiveness is available, is for people that are committed to, the nonprofit businesses or, identities. So it doesn't have to be at Mayo if you work for certain school districts or, to see if your employer qualifies. You're more than welcome to talk to your HR and see if your employer qualifies too. But this saves people a lot of money. Just be sure that you're on the right repayment program. Be sure that you make your monthly payments, the amount that they're telling you to pay, and be sure that you're working for the right employer and working at least 30 hours per week. So again, for understanding your repayments, and again, when grace period comes along, that's when your payments are postponed. That's considered 6 months for your federal direct loan. So you'll get that 6 months after you graduate your school, get your degree. You don't have to pay for the following, for 6 months after that. That's considered your grace period. The interest does not accrue on subsidized loan, but again, if you're on unsubsidized loan, the interest will accrue from the time of disbursement. Federal loan servicer, they handle your bills. So Just because you apply for your FAFSA, your school is the one that distributes it, your funds, but then the government then hires servicing companies to handle your accounts, right? So when you call about your student loans, you're not calling the government about it. You're calling the servicing company. You can find out who your servicing company are through your studentaid.gov, or you can log on to annualcreditreport.com. Again, your payment plans can be changed at any time for free. Just use the loan simulator on the studentaid.gov to estimate repayment with different plans. So here, the student loan servicers is a list of phone numbers for them. So some things to look out for. So if you're getting phone calls and they're saying that you owe them student loans, but they're not able to tell you, where they're calling from, how much you owe, stuff like that, and they just say to pay them directly, just know that that's going to be a scam. So unsolicited contacts, asking for your, federal student aid ID. Don't give anyone that information. Or guaranteeing immediate forgiveness. That's not true. They can't just give you immediate forgiveness. So these are some of the signs that it might be scams, and for you to really, perk up your ears and say, this might not be legitimate. Or some of the tactics they use for all scams is using urgency or limited time offers, or if they ask you for an upfront monthly fee to work on your to service your account. That's not true. They don't ask for fees. So all these servicers, servicing company, are legit ones that are listed here. You can also find them on student.gov. You can also just verify it on your creditreport.com too, or on your credit report. So what to do if you get one of those phone calls? Do not engage. Log into your account at student.gov. Change your password if you need to, just for some extra security. Or you can just contact our fire department or for me, and we can try to see if the phone call is legitimate or not. So now we're going to talk about private student loans. They're not backed by the government. These are just personal, private student loan provided here with May Employee Federal Credit Union. You can find them, just anywhere when you put it in private student loans online. Some of the top ones are going to be like SoFi or Discover. So just these are the private loans that we're going to be talking about. It stays off of lenders' policies and regulations. So there will be full deferral. So while you're in school, there'll be no payments while you're in school, but interest will still accrue. You can make interest-only payments, so make small payments to cover the interest. So that way, by the time you get out of school, you're only dealing with that current balance that you initially took out versus the balance plus all the interest accumulated over the next 4 years or so. So they're typically fixed payments, just like, when you get a loan to pay off your car, your house, they're typically fixed payments. So a fixed amount that's due on the same day of each month. And the borrowers make small fixed amount, or you can make small fixed amounts while you're in school too, if you want to set up that kind of payment arrangement. It's based off of your credit. So if you're just young, starting out, your credit's not as good or you don't have enough credit, you may need a co-signer. But once you pay off the entire balance, or if you choose to consolidate your student loans, your co-signer can be released from for meeting the requirements. Repayment terms are typically 5, 15, or 20 years. There's no prepayment penalties. So if you choose to pay it off sooner, by all means do so that way you can save yourself money in interest payments. So what are some of the pros and cons of refinancing with a private lender? So if you find that it's too complicated to deal with 17 federal loans, should you go ahead and consolidate it with a private lender? So some of the pros are potential for lower rates. If you have excellent credit, you may qualify for the low interest rate on it, which saves you money over the lifetime of the loan. You can have one simple payment to pay towards that loan, knowing that a portion of it goes to principal, knowing a portion of it goes to interest, and it's only directly towards that one loan, versus when you pay federal student loans, you may have multiple student loans. It can be, a portion of your payment goes towards loan A, and another portion goes towards loan C. You don't know how much is being applied towards principal or towards interest. So you can lower your monthly payments. You can choose a longer repayment term, up to 20 years for certain institutions, but it can reduce your monthly bill too. And then once you consolidate your federal student loans to a personal loan under your own name, you can release your co-signer as well. From your other old private loans or other federal loans. So refinance with private lenders, some of the cons: loss of federal protection. Pretty gives up all access to federal benefits. So when there was, a pause in student loan repayments, if you have private student loans, you're not eligible to qualify for that. Loss of forgiveness programs, less flexible hardship options. So, for example, if you're on a payment plan with the federal student loans, you can always call up your student loan servicer, let them know you're going through a financial hardship. They can put you on forbearance. Where you don't have to make payments for that month or for 6 months or for 12 months. You can't do that with private loans. Higher cost total, extending the repayment terms lowers the monthly payments but increases the total interest paid. So variable rate risk or fixed payment only. So the amount is fixed and not tied to your income if you choose to go with your private student loans. So what does this look like for Alex, right? So if he lowered his monthly payments by consolidating debt and getting a lower interest rate, so out of $27,000, his original loan original loan of $27,000. With the original loan with the federal student aid, maybe the average out of all of his student loans is 7.5%. But if he chooses to consolidate with private loans, it drops down to 5.5% or whatever rate it is you get depending on your credit. The repayment term with his federal student loans is 10 years. Same with his private loans if that's what he chooses to do. His estimated payment with his federal loans is $321.43. You can see it drop down by $29.08 with his private loans. So the total interest paid is a lot lower for private student loans, so that would give him more of a savings of $3,489.60. So the lower payments, lower interest rate has saved him more money over the course of 10 years for this scenario. Tips when you're preparing for repayments, pay more than the minimum. So you can call your servicer each month to make an extra payment to a specific account and pay principal only. This can be for your private student loans or federal student loans. It goes for any loans, actually. Know how many loans you have. So each loan have its own interest rate and how each monthly payment is dispersed with all of the loans. You want to keep your own good records as well. So for example, if you have like 10 federal student loans and they're asking you for a minimum payment of $100, you don't know how, unless you're going in each month to take a look and see how dispersing that $100, you'll, maybe they're putting a little bit more towards the lower balance loan with a lower interest rate, or if you want to have more of a direct control over how your payments are made, you can always make extra payments each month and just call your servicing company, let them know that, hey, I've made my $100 minimum payment for this month, but I want to pay an extra $100, but I wanted to put specifically towards loan A, towards principal only. So you can take control that way. But most companies, you can't do that automatically, so you would have to do that each month. But that is a good tip for you to try to pay off your loans a lot faster. So before you prepare to pay your loans, know who your loans are. Find your servicer, figure out your total balance, the interest rates, how many payments you have, when is your first due date. Again, you can always go to student.gov. You can always go to annualcreditreport.com or go to your loan servicing company directly. You want to update your contact information. You want to log into both accounts and verify your mailing address, phone number, and email. You want to choose a plan that will work for you, set up the payment and do auto pay, and get help if you need it. If you think you're going to fall behind or you are falling behind, get help. Just reach out to your student loan servicer. They'll be more than happy to work with you about getting back on track or see what kind of options will be best for you. But what happens if you don't pay? So if you can't pay, or if you choose not to pay, whatever the situation, what happens then? If it has been 270 days since your last payment, your loans are considered in default. You'll lose your eligibility for additional federal aid, so you can't really qualify to go back to when you go back to school, you can't qualify to get more federal loans out until you bring your account to current. It's being reported to the credit bureau. So each month that you're paying on time to your student loans, it's being reported. If the months that you're delinquent on your student loans, it's being reported as well. Tax refunds and federal benefit payments may be withheld. Your wages can be garnished, and your court action may be possible. May be charged, and then once it goes to court and you're being garnished, then you'll have court costs, collection fees, attorney fees, and other costs associated with the collection process. So if you're in this situation, or if you're seeing yourself getting close to this situation, reach out to someone. Reach out to your student loan servicer. Reach out to me. Reach out to a different financial advisor, different financial counselor, and see if they can help you get back on track. See if we need to adjust your budget in any way. Take a look at your budget and have a second set of eyes on it, and see what we can do to get you, have some extra payments going towards your student loans. So adjust your lifestyle to save some money, pick up a second job, of course, if time allows it. We can budget. I work with a lot of people to budget their finances, so you can meet with me on that. You don't want to ignore the mails and the letters and mail and letters and emails and phone calls and stuff. So again, contact your servicer, lower your monthly payments and see if there's a different program that you can qualify for besides the payment plan that you're on now. You can pause your payments, do a forbearance. You can request, to enroll in a loan forgiveness or consolidate your debt if that's, into a private student loans if that's what you need to, so that way you can get a lower interest rate. So if you find yourself in this situation again, please reach out to someone before it gets to the 270-day mark. If you want to learn more about what we have available for student loans, you can always visit our website, mayocreditunion.org, under student loans, and there'll be, under loans, you'll see the tabs for student loans for that. But this concludes our presentation for today. Do we have any questions online or anything? No? Okay, perfect. Well, thank you so much for joining us today, and I hope you guys have a wonderful day. Thank you.